Well, welcome into a daily editorial here on the KE Report, chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Jordan, one thing you and I were talking about off mic is this whole concept of what happens around major bottoms for the metals, gold stocks, that type of sector. And we get so many people on a consistent basis that are constantly calling for bottoms and saying, look at what's happening over here. This is signifying a bottom for gold and the gold stocks. But the fact of the matter is what we're seeing in the markets right now, when you truly take a level-headed look at it, is the fact that we might not be right around the corner from a major bottom in gold stocks. One thing you point out, and that's the first thing we'll talk about, is this advanced decline line. It is recently broken down even further and is at some lows that we haven't seen since September. Can you break it down, why you're thinking that maybe a major bottom for gold stocks isn't necessarily right around the corner?
Yes, Corey. Well, the advanced decline line is a breadth indicator, and so it tells you about participation. And essentially, in a healthy bull market, you really want to see a strong advanced decline line, which means you're seeing the vast majority of stocks in that market, the vast majority of stocks are rising. They're all going up. And we talked about this before. When a market is strongest, it's when everything in that market is rising, basically. So that can be different from a market going up because, let's say a portion of that market is just on fire and going up at a significant amount. That would be an example of not very strong breadth. So, and breadth is just another word for participation. And you can also read it the same on the way down. I mean, if the advanced decline line is really weak, and the market is not that, it doesn't look that weak itself, but it's relatively weak. I mean, that can be a bearish divergence, a negative divergence. And so with respect to the gold stocks, this GDX advanced decline line, I want to point out that around the January 2016 low, the advanced decline line had made what's called a positive divergence. So it made a higher low, while at that low, GDX made a lower low. And then as soon as GDX started rising, the advanced decline line exploded higher. So there was a positive divergence. I mean, that played out bullishly as one would expect. And the same thing was happening before the December 2016 low. And I remember this because I was getting really bullish, but a little bit too early. Before that, we had that low, I think, in the middle of December. I was getting bullish weeks before that low. And one reason, I mean, we're obviously very oversold, but the advanced decline line was just not, there wasn't quite yet a negative divergence, but it wasn't as weak as GDX itself. GDX in November of 2016 was selling off really hard, and the advanced decline line was just kind of trickling lower. And so anyway, we got that low in December, finally in the middle of December, and the advanced decline line exploded higher, and that was really strong in early 2017. But eventually it faded along with the miners. And the point is, what we're seeing here and now in the last couple months is we've seen a negative divergence as GDX rallied. GDX from its August failed recovery, from that point to its October high, that was a higher high. But if you connect the same dots for the advanced decline line, it had a lower low. So that was a negative divergence. And as of a day or two ago, the advanced decline line actually surpassed its early September low to the downside. So the advanced decline line a day or two ago for GDX, it hit a new 2.5-year low, which would imply GDX going down and testing its low around 17, and GDX is trading around 19 as we speak, a little bit below. So that participation basically tells us that the participation in the gold stock sector, or GDX specifically, has been very weak over the last couple months. And, that was kind of a foretelling that the rally wasn't that strong. And what it's telling us now is that gold stocks are, as they're starting to roll over a little bit, gold stocks are really weak, participation is really weak. So that's not a good sign for what's ahead.
And another concerning thing is that usually at these bottoms for gold usually actually corresponds with bottoms, or at least close to bottoms in markets as well. When we see selling hit U.S. equity markets or broad stock markets, it is sold across the board, and gold stocks follow a lot of these risk-on stocks down. Where, yes, we got a sell-off in, let's say, GDX over summer, but then we since have bounced. Today we're moving down further. What do you think, though, the potential of a further sell-off if risk-on equities get hit? That can easily extend to gold stocks too, can't it?
Yes, it can. And really, now, assuming we're going into a bear market in the U.S., gold and gold stocks are not going to follow the entire way down. Eventually, they're going to diverge, and that point is obviously probably going to coincide with the point where the Fed stops hiking and they shift their policy and people are talking about cuts. That's the point when gold stocks will really diverge and explode off their bottom. However, we're not at that point yet. The Fed still has a couple hikes to go. Some hikes are priced in, and I mean, I don't want to be an alarmist, Corey, but the technicals on gold stocks are just really bad. I mean, they're awful. Look, we had this breakdown in the summer, the rally that we got in September, early October. It basically just served as a retest of the failed breakdown because it peaked last week at resistance as far as GDX and GDXJ. Now it's rolling over again. I mean, this technical action is really bad. And if you look at what happened leading up to the bottoms in late 2000 and late 2008 in gold stocks, they basically crashed into those lows. Now, as far as what is a crash, some people will say, a crash is 50%. Some people will call 20% a crash. But if people are holding gold stocks and they're just thinking, oh, well, these have gone down enough, we're close to the bottom, it's okay, I'll just wait here. You can't do that. I mean, we saw this happen in late 2000 and late 2008. The advanced decline line's at a new low. The price action is horrible. These markets have potential to go a lot lower. I'm not saying 50 or 60% lower, but they can easily go 20 or 30% lower over the next couple months. And people need to understand that. And that, look, I've already said it, Corey, that this has happened before major bottoms. So there's a process to getting to this bottom in precious metals, and it's underway. But unfortunately, we're too early in the process right now. And early in the process, while things are improving for precious metals under the surface, when you're early in this process, you can still see precious metals decline. And so we're not later in the process yet. We're early in this process, and precious metals bulls, they have to realize that. Number one, things are under the surface are turning favorable for precious metals, but we're not there yet, and there's still downside risk.
So when you talk about something like sentiment as well and looking at the markets such as gold, the argument is that sentiment's so low that, we need to get some sort of a bounce back. All it takes is a little bit of money and sentiment will improve. But what do you have to say to those people who are trying to look at low sentiment numbers as a contrary indicator, but I think still understanding that sentiment can stay low and technically get washed out to levels that nobody wants to see, which is pretty much down to zero when no one cares about the sector?
Yes, Corey. Bearish sentiment is not bullish when you're in a bear market or a downtrend. That's something a great trader buddy of mine educated me on in recent months. So, and we can just see this looking at the COT, Corey. I mean, we've talked about it before. A lot of people are looking at the last 15 or 16 years of the COT. Nobody is looking at what happened in the 80s and 90s. And you know that I measure the COT, the net spec positions, as a percentage of open interest. And so when you get to negative, that means that the speculators are actually net short. And that happened in recent weeks for the first the first time since 2001 where speculators were net short. I think it got to -6 or 7%, something like that. Now, that obviously looks really good if we're just looking at the last 17 years. But if you go back and you look at the 80s and 90s, the net spec position got to -20% several times. It got to -30% a couple times. So the sentiment can get, I mean, there's room for the COT to get a lot worse. That's not going to prevent the market from going down further. And by the way, this is what happened in the summer because people were crowing about the COT all the way down as precious metals sold off. So you really have to look at, what happened in the whole picture, what happened in the 80s and the 90s. And you have to realize that, when there's a strong trend either way, sentiment, it can remain extreme for a while. So people they're not reading sentiment the right way, and they're not looking at a big enough history to analyze it and its impact on the market.
All right, so Jordan, for those people who are invested in the precious metals and the precious metals stocks, what do you want to drive home to them? Is now a time to almost clear out all of your positions or be even more selective, as I hope most people already are selective? Or is it maybe ride this a little bit lower and hope that we do get a bounce either at year end, after maybe some tax loss selling, or early part of next year? What do you want to leave the average investor who is invested in these precious metal stocks with?
Well, I don't want to say sell everything in precious metals, because there are some juniors that are doing well and that are making discoveries. And so I just don't want to say sell everything, but look, you have to look at what you own, and if the prospects are not there for the company to make a strong discovery in the near term, and the stock is not trending up, it's in a clear downtrend, you should probably get out of those, take your tax loss, and just move on to next year. Because I really want to drive that home, Corey. I mean, if you're thinking, oh, well, things have already, it can't go down anymore, things have gotten bearish enough, that, hope is not a strategy. You said the word hope. I mean, we know that hope is never a strategy. So unless they're stocks that you really know why you own them and you really like them, unless it's a situation like that, you're probably best served to raise a lot of cash here. I mean, in the model portfolio right now for the daily gold, I think before we went short recently, we're 62 or 63% cash. So I'm only holding a couple things with a huge cash position and then some short positions to offset everything.
Yeah, that's one thing I've noticed, is that you have put on some short positions just a couple days ago, and so far those are already paying off for you. And that is one way also to weather the storm if you don't want to sell your, let's say, junior stocks or mid-cap stocks or even large-cap stocks in the metals sector, is having that extra cash so that you can hedge yourself for what still looks like a, unfortunately, depressed and somewhat weak market. Jordan, good chatting with you. Thanks again for taking some time, and have a great rest of your week.